to this webinar on potentials and pitfalls of climate responsible investment. The third in a series of webinars focusing on how retirement savings can be invested in ways that help resolve rather than exacerbate the climate crisis. My name is Roy Culpepper. I chair the Group of 78 and I sit on the steering committee of Climate Legacy. These are the two organizations co-hosting these webinars. First, I'd like to acknowledge that the City of Ottawa, where I'm making these introductory remarks, is in the traditional unceded territory of the Algonquin Anishinaabe people. As we discuss how to combat the climate crisis, we must recognize that Indigenous communities have for many generations stewarded the rivers, coasts, forests, and the land. We must learn from their example and respect their legacy. Next, a brief word or two about our co-hosting organizations. First, Climate Legacy is a project to engage and mobilize older Canadians in climate action through their voice, their time, and their money. Our vision is that Canada moves steadily and effectively toward a zero net carbon economy in the next decade through actions at municipal, provincial, and federal levels. Seniors comprise a significant force in combating climate change, but are often overlooked in current mobilizing efforts. This is why we are establishing a climate action platform and resource dedicated to older Canadians initiatives. Next, the Group of 78. Since its origins 40 years ago, the Group of 78 has promoted dialogue about a progressive Canadian foreign policy based on the principles of sustainable peace, justice with equity, and survival of our planet in the face of modern human activity. Climate Legacy is a project of the Group of 78. Now, on to our discussion. Seniors with retirement savings and investment portfolios are concerned that their funds are financing fossil fuel and carbon-intensive products and activities rather than supporting renewable energy and green technology. We learned from Adam Scott in our first two webinars that the allocation of pension funds, which pool hundreds of billions of dollars of retirement savings, can have an enormous influence, for good or ill, on our climate. In this webinar, we move on from pension funds to explore the choices faced by individual investors as they ponder which mutual fund or other financial products, for example, green bonds, to buy. They are doing so even while the financial industry struggles to rebrand its products in order to meet environmental, social, or governance, so-called ESG standards. But many ask about these standards. Can these labels be trusted, or do they amount to greenwashing? To answer these questions, we are fortunate in hosting three individuals with in-depth knowledge both of the financial industry today and of the issues relating to responsible investment. And I'm going to introduce them very briefly. Tim Nash is the founder of Good Investing, an investment planning firm with a focus on sustainable investing. Tim's blog, The Sustainable Economist, has inspired thousands of Canadians to invest according to their values with model portfolios to reflect different definitions of sustainable investing. Tim writes a bi-weekly column for the Toronto Star and is regularly featured in CBC's The National, BNN Bloomberg's Markets Call, and the Globe and Mail. Next, Mary Robinson is Director of Research, Policy and Collaboration with the Responsible Investment Association, RIA. In this role, Mary promotes awareness of responsible investment in Canada through research and analysis, advocates for policies that support responsible investment, and facilitates collaboration among the RIA's membership. She is keen to advance the understanding of RI among Canadian investors and to help the industry move towards full adoption of responsible investment. Now, our moderator, Tessa Hebb, is a distinguished research fellow and past director of the Carleton Centre for Community Innovation, Carleton University, Canada. She is also an adjunct professor in the School of Public Policy and Administration and the Sprott School of Business at Carleton University. She has published many books and articles on responsible investing and impact investing. Finally, a disclaimer. Neither Climate Legacy nor the Group of 78 are recommending or disapproving, for that matter, any particular financial product or service. Rather, it is our hope that this discussion will help those who have funds to invest to do their own research, speak with their financial advisors, and make their own investment decisions. With that, I'll turn things over to Tessa. Tessa, thank you for moderating our panel.
Thank you, Roy. It's a real pleasure to be here today and to be with the group. I see there's quite a number of participants on the webinar, which is terrific. And, you know, I'm going to turn things over to Mary and then Tim before we open up to questions. And it's, for me, this is a very critical and important topic around responsible investing and the role that individual investors can play. And I'm delighted that we're taking on this topic today. So, Mary, I'm going to turn to you first to give us a bit of an overview around responsible investment.
Thank you very much, Tessa. I'm going to share some slides with the group right now. So bear with me as I bring them up. How's that look, Tessa?
Yeah, that's great.
Thank you. Thanks. So I want to thank you so much, Roy. It's really a pleasure to be here along with Tessa and Tim to talk about something that's near and dear to my heart, which is responsible investment and how that actually translates into actions that investors can take. This is, you know, climate change is certainly the, you know, the most significant issue that we're facing right now on our planet. And it's important to me to make sure that we all know that we can also address climate change within our portfolios and within our investments and our savings. So Roy already brought up our first acronym of the day, which is ESG. So environmental, social, and governance issues. And I just list here some of the key issues that investors are considering when they are responsible investors rather are considering when they're building their portfolios, when they're doing their research, when they're selecting securities to put into their portfolios. So of course, climate change is the #1 issue that responsible investors are looking at right now, both in terms of the environmental impacts and also in terms of some of the engagements that they're undertaking with companies. And I'll talk a little bit about what that means. There's other environmental issues, of course, biodiversity just being one. We also look at the S components of ESG, labor practices, health and safety, Indigenous relations. Labor practices was something that came up very strongly for responsible investors in 2020 with COVID. And so, for example, groups of investors coming together and writing to companies to say, make sure that you are offering paid sick leave for your employees. Make sure that you are not laying people off because of this COVID pandemic. And then finally, on governance issues, the G, board diversity is very important, making sure that boards have appropriate representation from women and from minorities, we use BIPOC, Black, Indigenous, and people of color, as well as people with disabilities. So making sure that there's a broad diversity of representation and hence views being represented on a company's board of directors. And then finally, executive compensation, also again something that came up during COVID, making sure that the ratio of executive pay to the average worker pay makes sense in the context of the business. So ESG issues cover, this is very broad. And these are things that I think as individuals, we look at in our day and we think about, and we can think about how do we change our consumption decisions in terms of, what companies do we want to buy products from? We want to know that they have proper labor practices in place. What choices do we make in our personal life in terms of, what are the steps I can take to in my lifestyle to address climate change? And, let's say diversity and inclusion. Well, that matters to me. We saw in 2020 a real social awareness, a real reckoning in terms of racial injustice and how that plays out. So things that we think about in our day-to-day life are also applicable within our investments and the decisions we make there. So just to give you a little more jargon to kick things off today, I want to talk about then what is responsible investment. So, and very broadly, it's incorporating those ESG issues, only a few of which I listed on the previous slide, into the selection and management of investments. And there's not one size fits all to responsible investment. And this is, on the one hand, the great strength in RI is that it can be used in so many different, it can be applied in so many different ways, but it's also a big source of confusion. And so hopefully we can clear up some of the confusion today. What most of us think about as responsible investing is what I've categorized on the left-hand side of this slide here as exclusionary practices, so negative screening. And this is where, as an individual investor or as a portfolio manager, I choose to exclude from the universe of companies that I'm looking at certain companies based on maybe my personal values, ethics, or negative ESG characteristics. And so traditionally, this has been looked at as a responsible investment or termed as socially responsible investment. Very long legacy of this investment practice taking place. Really, in modern investment times, it would go back to divesting from South Africa to protest against apartheid. And by the way, investor action actually did contribute to leading to the downfall of apartheid in South Africa. Very traditionally in Canada, we see exclusions based on tobacco or weapons. And more recently, of course, given climate change, we're seeing more and more discussion about excluding fossil fuels, divesting from oil and gas companies. So these strategies all come under negative screening. But again, responsible investing encompasses all of these strategies here. So there's also what we generally term as inclusionary strategies, which is not saying I won't invest in this particular sector, but it's saying, for example, I want to include leaders in ESG practices. I want to reflect the positive themes in ESG and investing in those. And ultimately, I might even want to have an impact. So let me just go through those 5 categories there. ESG integration is the broadest application of considering ESG factors in building an investment portfolio. And this is where the portfolio manager says, I'm going to assess a number of issues that have a material financial impact on a company's business because that helps me better manage the risks in my portfolio, and it helps to improve my returns. If I know that a company is executing well on its climate change strategy, then I expect that company to outperform, for example. If I know that a company is treating its workers properly and it's managing its supply chain risks, then I think that that has a lower risk profile than another comparable company that isn't taking the same actions. So this can be considered across broad portfolios, across broad asset classes, and it's the most prevalent strategy among Canadian investors currently. Positive screening is the flip side to negative screening, right? So rather than saying, I'm going to exclude companies of certain characteristics, this is saying, I want to include companies in my portfolio and direct my investment towards those companies that have positive ESG performance relative to their peers. So think of this as a best in class. So within any particular sector, I want the best ESG performers. And that has some overlap as well with thematic ESG investing. And this is where we can look at specific themes within each of E, S, and G issues, where there's structural changes taking place in industries, and that there's an opportunity to benefit from improving performance from companies who are leaders in clean technology. That would include renewable energy, for example, women in leadership, so addressing the diversity considerations, and the sustainable development goals as well would be a thematic investment. And then the next strategy to talk about is engagement. And this is where investors are using their shareholder power to engage with companies to improve their corporate ESG performance. And this can take the form of voting proxies. This can take the form of filing shareholder resolutions. And this can also take the form of engaging one-on-one with boards of directors and senior management to make sure that they are improving their performance on ESG issues. And this is a very, very powerful way of exerting influence over a company's strategies. And then finally, last but definitely not least, and a very exciting area in responsible investing is impact. And this is looking at generating a measurable social and or environmental return alongside a financial return. So this is really taking a very targeted approach at investment in order to generate a social environmental benefit, measure, report on those benefits, and with an expectation of earning a return as well. A lot of information there. If I just summarize this up, think of responsible investing in three buckets: exclusionary, and that's the negative screening; inclusionary, broad number of categories, looking at including ESG performance in your portfolio; and then impact. So RI is growing in Canada and globally. We did a survey as in 2020, as of December 2019. Total responsible investment assets were $3.2 trillion in Canada, and that represented 62% of the market for professionally managed assets in Canada. So it's more than the majority. Responsible investment is really the mainstream approach to managing assets in Canada now. We survey the respondents to the institutional survey respondents about why do they consider ESG factors in building their portfolios and making their investment decisions. And there's a clear overwhelming response from the marketplace. Portfolio managers are looking to minimize risk over time, improve returns over time, and fulfill their fiduciary duty. And this is really stating that there's a material benefit to addressing ESG factors when making investment decisions. Now, that was looking at the overall broad market. Let's bring it down to more the individual investor level. We also are looking here at retail responsible investment funds. And so this is looking at funds that are specifically designated, labeled, and marketed as responsible investments. So it's not looking at the broad ESG integration universe. This is looking at very specific RI strategies. So negative screening, positive screening, and thematic funds primarily. So as of December 2019, we totaled about $15 billion in retail mutual funds, so available to individual investors that were invested under responsible investment strategies. And a small but growing segment of the market is exchange-traded funds, where we saw $600 million in assets under management. So that was as the end of 2019. Just to give you an idea, there were over 40 funds, responsible investment funds, launched in 2020. And the stats as of the end of the year 2020 were there were 88 mutual funds and about 40 exchange-traded funds or ETFs. So there's really, the market share is still small in the retail space, but it's growing, and fund companies are certainly seeing a huge opportunity to expand their product offering in this area. So now focusing a little more on individual investors. Each year, the RIA surveys 1,000 individual investors to get an understanding of their knowledge about and their interest in responsible investment. So we asked it last year, 1,000 investors, to what extent are you interested in responsible investments that incorporate ESG factors? And about 2/3 say they are interested in responsible investment. We're able to slice and dice this by demographic groups. The interest was highest among the younger age group. And that's been a story we've been telling for a while about, the millennials and their interest in responsible investment. Also households with kids, very high levels of interest, and stronger interest, slightly stronger interest among women compared to men. In the retail space, though, so we know there's a high level of interest in responsible investment, but in fact, about 3/4 of the survey respondents said they didn't know very much about RI. So there's a big knowledge gap that they're experiencing. And so the question is that we posed to the investors was, has your financial advisor or financial institution ever asked if you're interested? And I'm showing here results from the previous survey in 2019 as well as the update in 2020. And these are the yes respondents. So 48% of the 18 to 34 age group has had that conversation with their financial advisor or financial institution. But you can see that level of conversation, that percentage of yes response, drops off with the higher age groups. And what do we see in terms of ownership of responsible investments? Well, we're seeing that ownership is increasing. So interest is high, knowledge remains quite low. Conversations could be happening a little more frequently, but even with some of those challenges for the individual investors, about half of the respondents in the 18 to 34 age group currently own responsible investments, 30% in the 35 to 54 age group, and 20% in the 55 plus age group are currently invested responsibly. And particularly encouraging to see is we also asked, are you more or less likely now to invest responsibly than you were 1 year ago? And so this is the response rate of those who are more likely to choose responsible investments now than a year previously. And you can see, a good proportion of the 18 to 34 age group are more likely now than they were a year ago, and more than half of the participants with kids as well. So going back then to the institutional survey from last year, we also asked, what do you think will be the main drivers for responsible investment over the next 2 years? And number one, okay, so now I'm bringing together the individual perspective and the institutional perspective and saying the number one answer was investor demand for ESG and investor demand for impact in their investment portfolios. The second main driver, climate change, and that ties in very clearly to number three, greater public awareness of ESG issues. So it really seems to be coming together in terms of, we started off talking about those major ESG issues that we think about in our day-to-day lives, and we're seeing now how that is translating to greater demand and growth in the responsible investment space. I'm just going to close off now. I would just want to give you a few resources, and we can talk about this a little more in the discussion if you're interested. Please check out our website. There is educational material there available to the public. And you can also check out the RI Marketplace, which is a free searchable database of RIA members, including investment advisors, who post about their products and their services. There is also a searchable product listing there where you can look at screening different strategies, different asset classes. Please feel free to jump in there at any time and start exploring the RI Marketplace. Thanks very much.
Mary, thank you very much for that terrific overview on responsible investing. It's certainly given all the participants lots to think about. Before I go to Tim, I just want to say, I know that many of you have already seen the Q&A component where you can post your questions. And I understand that there's an ability for you to put a like or a plus to a question that you already see, and that'll move it up the list of priority for me to address when we get to our Q&A. So think about your questions as we go. We're going to go to the Q&A after Tim gives us a little bit of a bird's eye view on individuals' actions. We've gotten a great overview from Mary about responsible investment and what it is, but we know that for the panel today, we want to also dive deeply into what choices are out there for individuals. So Tim, over to you.
Sure. Thanks so much. Appreciate that overview, Mary. I'll try to keep things quick just so that we can jump into the Q&A. I see some great questions popping up there already. So I'm sure that this topic tends to open up a bit of a can of worms. So I think we'll have a lot of fun there. Really what I want to communicate, so my job as a CFP, Certified Financial Planner, is much more on the practical side of things. That I've helped hundreds, if not thousands of people basically actually implement this stuff. So saying from wherever you are now with whatever investments you have now, how do you actually switch and get things over? So really what I want to do is provide a few different paths kind of on the higher level. I'm going to stay out of the sort of the nitty gritty details for now, but really just want to communicate, specifically understanding that the audience here primarily is seniors, that you have a few different paths available to you if you do want to switch over to responsible investments. So the first thing is like talk to your advisor. That most of us have existing advisors, planners, etc., someone that you've been working with, and that really the first step in your journey is to start asking tough questions. Don't wait for them to bring it up, right? We saw in the survey that only a small number of seniors have ever even been asked about this, and that really the first thing you can do is be proactive about bringing these things up, and take some of the lessons that you're learning today and some of the language and start asking, I would say, some tough questions. Know that a lot of the big banks and large financial institutions, they all have product now. So 5 years ago, 10 years ago, a lot of them didn't have anything. So it was like you'd bring it up and it was like, sorry, we don't have anything for you. Whereas now almost all of them do. Obviously, the challenge is understanding which ones are sort of legit, and actually sort of sustainable, and which ones are just greenwashing. Because a lot of the sort of big financial institutions, the products they have are, on the weaker side of the spectrum. And so it's about understanding where you're at. If you want to speak to your advisor, if they do suggest funds, really what you want to have them detail for you is the methodology that the fund is using. So what are those negative screens? What is the ESG integration and the sort of threshold for best in sector, right? And then also get a list of all the holdings. They should be able to provide you with a list of all the companies that are inside of these different funds. And with that information, you can kind of go through the methodology, understand sort of what are the negative screens, understand what are those sort of ESG thresholds that they're using, and then go through the companies and, see whether it passes the smell test for you. Everyone has such a different idea of what responsible investment or sustainable investment means. So if you open it up and you go in there and you start to see companies in there that you're like, wait a minute, these are flags, bring that up. And that's a really good exercise to help figure out where you are on the spectrum, and then to communicate to your advisor that, hey, this isn't going far enough for me. What else do you have? Right? And really, you are paying them fees. So put them to work, get them working for you. Some advisors just won't even have the conversation. I'm really curious to know if there are people who have tried doing that with their advisors. And, I have clients that come to me because they got laughed at, or, they got completely dismissed by their advisor saying, oh, this is a great way to lose money, when in fact, performance of these responsible investments has been just as good, if not a little bit better than traditional investments. So, if that's the case, if your advisor just doesn't have what you want, then, the next step would be to find another full service advisor that, especially for seniors, if you've got more than about $250,000, right, that you'll meet minimum requirements for. There are a lot of advisors in Canada that would love to take your money and are more than happy to work with you to find an investment product that actually does align with your values. So, especially if you are, sort of, in retirement or approaching retirement, probably your portfolio is a little bit bigger, that you can find another full service advisor. If you're looking specifically with this crowd, I know climate's a huge issue. So if you're looking for fossil fuel free and full service advisor, I've got a number of full service advisors on my list that would be more than happy to take your money and invest it for you in a manner that is fossil fuel free. And there's a good chance that, by shopping around, you can actually lower your management fees. So for a lot of my clients that do sort of hire me to do sort of a manager search, not only are we able to make your investments more sustainable, but we're also actually able to save you money on management fees at the same time. So to me, that is really sort of a best of both worlds scenario. You still get the full service, right? So all the help that you need, you don't have to worry about it. They'll look after it for you, but it's in a way that's aligned with your values. Now, for the more adventurous people in the crowd, or for the people that are much more stringent and very specific about what they want to invest in, then, that's when you can look at the do-it-yourself investment approach. This is my bread and butter. This is with my firm, Good Investing, this is really what I help people do, is to manage their own money online using these ETFs, exchange traded funds. And again, so many options are available now and more coming out. Like every week, like every month, I feel like there are new ETFs coming out. And again, a wide range of options that are available. Everything from sort of a small step in the right direction, right, all the way through to things that are sort of like squeaky clean from a sustainability perspective. Now, my only concern with bringing this up is that, especially for seniors, if you are approaching retirement or in retirement, it gets tricky doing it yourself. That you have to manage a lot of different things in terms of, your RSP turns into a RIF, and when you start withdrawing. So the DIY approach is, I would say, easier for people who are still younger and in the accumulation phase. That's really the core of my target audience, are people that are earning money, saving money, and just want to invest it long term. As soon as you start approaching retirement, or you're in the decumulation phase where you're pulling money out, that's when you are going to need a little bit more help. You can still go the DIY approach, but you're going to want to get something we call a comprehensive retirement plan. You're going to want to sort of have a team of maybe like an accountant plus, a CFP plus, maybe an estate lawyer or something if you're starting to look at some of those end of life plans. But that's where, you can do it yourself, but you are going to need some help, and to find some of these sort of independent third-party folks, such as myself, where, we're not going to manage it for you, but we're going to kind of hold your hand and provide research and coaching as you do it yourself. So those are kind of like, I would say, the three different paths that I would really suggest people start by kind of having that conversation with your advisor, see how it goes, see if they find something that takes the bill. If that doesn't work and you just don't want to do it yourself, then that's fine. Maybe we can find you a full service manager that really does fit the bill, that'll kind of do everything for you, but do it in line with your values. And then, really, if you want the really sort of like most sustainable and cheapest option and are willing to do a lot of the work yourself, that's when, we can have these sort of DIY portfolios where more and more people are managing their own money. And obviously that gives you complete control over the choices and the sort of sustainability decisions that you're making.
Thank you so much, Tim. Some really good advice for folks there. Now, you're not going to be surprised that there's quite a number of questions for both Mary and Tim that have come up in the Q&A. And remember, if you want to move your questions up, move a question up, just click the thumbs up like button and it'll come higher on my screen. But I'm going to start with Ellen Adelberg. And Ellen, where'd my questions go? Ellen asks, about the number that you used, Mary, in one of your slides, which was 62% of assets being invested responsibly. She's saying that seems to be higher than the actual amount of business that's meeting these high ESG standards in Canada. So just unpack quickly that 62% level that you demonstrated.
Yeah, it is a big percentage. So what we were looking at is, so we surveyed over 100 institutional investors on their responsible investments here in Canada for Canadian clients. So I think, first of all, keep in mind, it includes all asset classes. So that would be Canadian equities, Canadian bonds, as well as global equities, global bonds, real estate. So all the asset classes, and we have assets being managed in Canada that are allocated globally. Second of all, the respondents to the survey, they do self-identify as responsible investors, and they are counting ESG integration, as well as their specific, say, RI strategies, so their negative screening strategies. So what we are seeing over time, the reason we're seeing that market share increasing so much is more investment managers are applying ESG integration across all of their asset classes. So whereas before you might have had a manager saying, okay, we've done some ESG integration on our equity management process, but they hadn't done it on fixed income. So now we're seeing it being broadly adopted across all asset classes, which includes both Canadian, non-Canadian, as well as real estate infrastructure, for example.
Thanks, Mary, for unpacking that for us. Now, here's a question probably toward Tim. Barbara Riley says, and several people have put a thumbs up on this, Corporate Knights magazine issues regular reports on corporations' environmental and gender stance. Are these a reliable source for investment possibilities?
Okay, so Corporate Knights, great publication. I do a lot of writing for them. What I would say is that they've got their own research methodology, so they kind of have their own research team. So there are a number of different data sources that we use. Corporate Knights would be one. They have their own. There's also, I saw MSCI. I think I saw something in the chat about that. And Sustainalytics, which used to be Jancy Research, and Jancy Research has merged with Sustainalytics. So all of these companies are going to have their own methodologies and their own sort of like scoring system. And I would just say, grain of salt with all of them is that understand that when it comes to these scores, ESG scores, that it often doesn't look at the product or service that the company is selling, and instead looks at their policies and procedures and disclosure and performance. So this is something that trips a lot of people up, that you can get a company like Suncor, which is, tar sands, but is kind of the most responsible tar sands company in Canada, having a fairly high ESG score, whereas a company like Brookfield Renewable Partners, which is a renewable energy utility, but Brookfield they just don't report on ESG issues. They've just been a real laggard. I think they're about to start to because the trend, but historically they haven't reported on this stuff, such that Brookfield Renewable often ends up with a much lower ESG score than Suncor. And that throws a lot of people off, right? In the same way you can have a company like Philip Morris, which is tobacco, or Nestle, having high ESG scores, which, so this is my way of saying Corporate Knights, I think, is a wonderful resource. I love it. I just wrote the foreword. They're going to have their fund ranking methodology, and I think that does a pretty good job. It's not perfect, but it does a pretty good job on the fund side. And with any of these scores, with any of these things, you have to sort of look at the data and the ranking, but then you have to also trust your own instincts. That when it comes to ESG and sustainability, in my opinion, it's more of an art than it is a science. So when you're looking at the scores and the more scientific aspect to it, you need to understand the kind of like artistic interpretation that's involved there. I know it can be a little bit frustrating for people because it is a sort of a bunch of gray areas, but I would say that Corporate Knights is a wonderful resource for these types of things. But I would never take any score at its face value. I would always want to check it against MSCI and Sustainalytics, where they do have some scores available for free. And then I would always want to check it against your own personal heart, and make sure that it does sort of fit in nicely there.
Here's a question for either of you. David Slade asked, and I actually noted this question in my own questions that I had prepared, but no need to go to those. It seems to me, David says, that when one of the big five banks who are heavily invested in fossil fuels offers fossil fuel free investments, it's sort of like harming people and the planet, but selling food and bandages to orphans and the injured out the back door. the comment is better than not selling the food and bandages, right? But, I think this does raise a question. And Arlie Luckett asked, in addition, what about when their own stock is included in green mutual funds, overlooking the role that they're playing in financing oil and gas? And what I would say here is we know that for many of our older Canadian segment, they are using the banks as their primary vehicle for these kinds of investments. So, Mary, do you want to take a stab at role of the banks, and then Tim?
Yeah, that's that really is such a key issue, and we hear this all the time. In a way, I don't want you to see me as an apologist for the industry by any means. I'll just look at this from an investment point of view. First of all, banks have been a significant lender to the fossil fuel industry. That is true, and it's a big part of their business, and a very important source of capital for the fossil fuel industry in Canada. And that's just the fact of, who we are as a country, and the benefit of our natural resources. But I would say that the banks are increasingly, and without, no one is absent from this conversation about climate change anymore. There are certainly, a number of initiatives underway for the banks to address climate change, not just in their operations, but also in their financing activities. And a number of the banks are setting up their sustainable finance departments who are focusing on not sort of non-traditional financing for the future of sustainability. So we are embarking upon a transition to a lower carbon economy, and that requires capital. That requires businesses, industries, reconfiguring how they manufacture, how they get products to market, how they manage their supply chains. So it's a reconfiguration of existing industries as well as new industries coming more to the forefront. For example, renewable energies. So we need to look at, how do we fund? How do companies who want to lower their greenhouse gas emissions, manage their climate change risks? The banks are actively involved in providing transition financing for that. And I will say as well that the banks have also been supporting, this gets a little esoteric, but the development of a taxonomy or a classification of activities by high emitting sectors in Canada, classifying particular business activities that would qualify as transition and to qualify for transition financing. So there's a shift taking place. We're the big cruise ship, and we're going to, slowly, but I believe surely start to adjust some of that, where the financing is going. There's a huge investment that's required in order to make significant improvements to our climate change outcomes. And I'm increasingly seeing the discussions turning into real plans, real strategies, real pathways to achieving that, even among the financial institutions. How about you, Tim?
Thanks.
Sure.
Well, and before I go to Tim, I'm going to add in a question from Susan Tanner, because she also says, well, can you maintain a good return on your portfolio without investing in the banks? So you're getting a double-barrel question.
Well, I think a triple-barreled, I feel like there are a few different things in there. So first of all, and you know, I want to be clear, I'm such a supporter of the RIA and the work that they're doing in Canada in this field. I've been, you know, a member for a very long time and I love it. But I think it's also important to acknowledge that a lot of the big banks are some of the biggest members and sponsors of the Responsible Investment Association. So I think Mary's response was very diplomatic. I think for this audience, I don't need to be diplomatic. I can sort of, you know, speak off the cuff here, which is to say that, in my opinion, that the banks are much more interested in talking about these issues than they are about taking action on these issues. Now, I have a lot of friends who work within the banking sector in their sustainable finance teams and departments, and I spend a lot of time going through these products to understand which ones are legit and sort of which ones are greenwashing. And I got to say that it is the products by the larger banks here in Canada that are much more on the greenwashing side of the equation. So I get really, really, really frustrated by the banking sector here in Canada. To be clear, I'm a huge supporter of the credit union system. So if people are doing their banking through the big banks, I would strongly urge them to look at the credit union, which are sort of a nonprofit and offer a lot of the same products and services. You know, I want to speak about a couple things. Let me start with the financial piece, the returns, because I think this is a huge issue. And, you know, that the biggest myth that people have is that when you do responsible investing, sustainable investing, that you automatically have to sacrifice returns. And that is not the case at all. That we have data going back 10 years, 15 years, 20 years, showing that responsible investment returns have done just as well, if not better. Now, obviously, you have to understand where you are on that spectrum. That obviously, if you're doing the most basic negative screens and most basic ESG integration, where the big banks will still be inside of those funds, then your returns are going to be very similar to the benchmarks. The more you go down the sustainability spectrum, the more there are trade-offs involved. However, returns have not been that trade-off. That the more sustainable products have actually outperformed over the last 5-10 years. I can't promise that'll continue. I don't have the crystal ball, so I don't know if that'll continue into the future. But had you, for example, divested from fossil fuels 10 years ago, you would have done better than those who hadn't, point blank. So, you know, really to me, it's about understanding the banks are profitable, yes. By excluding them, does that mean we're necessarily sacrificing returns? No, because there are other companies in the market that are just as profitable as the banks. Now, the trade-offs that you do get as you become more sustainable is that sometimes you get higher risk. So you might be investing more in tech companies than in energy companies or banks. And tech companies are higher risk. Now, they've performed better, but they are going to be more volatile, which for seniors, that's a huge concern. As well, there is a trade-off in terms of fees, that oftentimes the most sustainable products are more expensive than the ones that are a small step in the right direction. So I want to be clear, there are trade-offs as you become more sustainable with your investments. Returns has not been one of them, okay? Now from there, to address the issue with the banks and the products that they have, when it comes to the banking sector, you really need to understand the divisions within the banks, that every bank has different silos. Okay, and they are not supposed to talk to each other. Like, they are supposed to be very separate. And so the capital market side of it, which is the section of the bank that's going to be investing in pipelines and tar sands and loaning money to these large corporations, is very different and separate from the investment management side of it. Now, is there some overlap? They're not supposed to talk to each other, but if they're in the same building and they're friends with each other and one person used to work there but now works over there, you know, inevitably there is going to be a bit of overlap there. And so I think it's important for people to understand that inevitably there might be conflicts of interest. But this is why, you know, I want to come back to my first point, which is that when you're evaluating a fund, I don't care the brand name. It can be from RBC or BMO. But when I look at the fund's methodology and what they screen out, and when I look at the actual companies that are inside of those funds, that's when I can make a determination about sort of how sustainable something is. And that, you know, it is a personal preference that some of the banks are doing some good things. They're moving in the right direction. I would say they're moving a lot slower than I would like them to move, and that there might be more talk than there is walk, at least for now. Hopefully, you know, there is going to be more of that walking, especially as they're forced to disclose a lot of these investments under a lot of the new disclosure rules. I think that's going to force some action. But in my mind, you know, when I look at it, these are, you know, really, they've been kind of dragging us, you know, in terms of a lot of our climate goals, a lot of the conversations there. So for me personally, the big banks here in Canada are a bit of an ethical red flag based on the investments that they're making through their capital market decisions. That said, just because I don't want to invest in them and own their stock in my fund, it doesn't mean that I won't buy their product. That if BMO comes out, like BMO came out with the clean energy ETF, you know, that doesn't have any banks inside of it. You know, I'm not going to hold it against them that that's a BMO product, right? But, you know, if you are looking inside some of these ETFs and you're seeing, you know, the companies that are at the top of the climate leaders, which are the JP Morgan Chase, Bank of America, RBC, I think are kind of some of the top ones, then for me, if I'm trying to divest from fossil fuels and I see those banks in there, I know that, wait a minute, you know, this might not be totally in line with my values.
I think we have time for one last question. There's 18 questions here, and Roy did tell me that it's a lively group and many questions would come forward, and they have. But this one's received quite a few thumbs up, and it's from Jim Cornelius, and he is a bit of a skeptic. He says, how does this type of investment actually change anything besides making us feel better? And I'm going to ask each of you to use this as your sum up just for a minute or two. Go to Mary first.
All right, thanks. You know, in one way, I can look at this very simply, and you know, if I sleep better at night because I know and understand how my money is invested in, and I'm comfortable with that at a personal level, and I'm not foregoing returns, then, you know, that has sort of a non-measurable value to me, right? But if I look at it in terms of, you know, how can this actually have an impact or affect change? Again, remembering there's these exclusionary or screening strategies and the inclusionary strategies. On the exclusionary strategies, if I say I'm not investing in fossil fuels, you know, what I'm left with is then where else does my money go? And as Tim just so aptly really pointed out, if I invest in banks, I have fossil fuel exposure. If I invest in real estate, I have fossil fuel exposure. I mean, this is the whole thing about climate change, is that it is systemic. It does affect every sector. So I could take a view then, if I don't think, if I want to address climate change and have an impact, what can I do? Well, I can think about managing my risk. I can think about, again, making sure, first of all, that broadly ESG issues are being addressed in my portfolio. I can make sure that I'm holding leaders in each sector in terms of how they're addressing climate change. And then I can look to my portfolio manager to engage with companies. Right? So this is where they're having a dialogue with company management, company boards of directors to make sure that they are improving their ESG performance. So you will move the needle. Shareholders do have power and they do move the needle. Engagement is a really powerful strategy.
I'm going to get one last word from Tim because we are at 11:59. Thank you, Mary.
So here's the drill is that, and forgive me, this is like a whole hour-long topic about does this stuff make an impact and how it works. But really what it comes down to is an economic term called the cost of capital, which is a company's cost of capital. It costs them money to raise money through equity or debt. And there's undeniable evidence that exclusionary and negative screening for example, in the oil sector, raises the company's cost of capital, meaning that the more people that are not investing in the oil sector, it makes it more expensive for them to raise money, which makes their projects less profitable, which means they're building fewer projects. And the opposite is true, that when more people are investing in renewable energy companies, what that does is it lowers their cost of capital, makes it more accessible and affordable for them to raise money, and means more renewable energy projects will be built. So that's like, in terms of secondary markets, stocks and bonds, traditional, that is like the definitive thing that I can point to that we are going to have an impact. But for me on a personal level, all of that, you know, the sort of the stocks and bonds on the traditional side, that's cool, that's great. That's like the bulk of my portfolio. But the part that really gets me excited about impact is the impact investments. And this is where, you know, if you have a traditional portfolio of stocks and bonds, you can carve out part of your portfolio for things like community bonds, green bonds, solar bonds, microfinance. There are a plenitude of products here where you are not investing through the secondary market. You are loaning money directly to nonprofits and co-ops who are having that positive impact. So I can point to my 3 impact investments, solar bonds, where I loaned $1,000 to a nonprofit solar energy co-op here in Ontario that helped them build renewable energy projects in Ontario. The Center for Social Innovation, where that helped a nonprofit buy a building in downtown Toronto that is a home for social entrepreneurs, and a Sketch Community Bond, which is a nonprofit here in Toronto that provides arts programming to homeless youth, creating a safe space that is allowing them to buy their building here in downtown Toronto, protecting them from rising rents.
And now I'm going to thank you both. Those are some great ideas, Tim. And, you know, it probably is another topic for another day. But thank you, Mary. Thank you, Tim. A wealth of information. Most critically, from my point of view, that when we're tackling climate change, we have to use every tool at our disposal. And on that note, I'm going to turn it back to Roy.
Thank you, Tessa. Obviously, we could have gone on for a considerable time tackling the number and the really challenging questions that were in the queue. So apologies to those who we didn't, whose questions we didn't get to. Obviously, there are both potentials and pitfalls of responsible investment, and you know, it shows the challenges facing those who are looking to invest their portfolios in climate-friendly ways. I thought one of the interesting pieces of data that emerged, particularly in Mary's presentation, was the seniors seem to be lagging behind younger generations, like younger folk, in terms of both their awareness about the possibilities of responsible investment and actually doing something about it. So I think for Climate Legacy and the Group of 78, our work is cut out. We need to raise the consciousness of the demographic that you know, we're trying to mobilize to make a difference while there's still time, so to speak. Thank you to both our speakers for shedding so much light. I think more light needs to be shedded yet. One of the questions I would have asked is, why isn't there a formal certification process, an ISO type of approach to put this on the table and make it open for scrutiny by others who want to drill deeper and figure out whether ESG is for real or not. So anyway, let me leave that as something to give further thought to. So thank you to Tim and to Mary and to Tessa for such a stimulating conversation. Thank you to all of our participants for asking such penetrating questions. And please keep in mind that this whole webinar will be uploaded to the websites of both the Group of 78 and Climate Legacy. And in closing, I just wanted to draw your attention to upcoming webinars. Wednesday, April the 21st at 3 p.m., the G78 and Cloud Group are doing a webinar on hot takes on the federal budget. Where are we going with feminist foreign policy that was introduced by the Liberals in 2017. We're going to have speakers on aid, trade, environment, defense, and diplomacy. So that's something to put in your calendars. The next Wednesday at 3 o'clock in the afternoon. A final word of thank you to Sarah Bowles and Emma Bider, who were in our control room, making sure that things flowed smoothly and well. So keep well, everyone. Stay safe, and keep talking to your investment manager and make him or her tell you the truth. So goodbye, and thanks for participating.